Welcome back to the Cash Compound, everybody. It's Jadu and Jonah coming to you from Greenville, South Carolina, where we help people crack the code to cash flow. This show is all about your money. It's about building wealth, and it's about never having to lock up your money, give it up to someone else's control, or taking risks with your capital. And many of you have known, if you follow along with what we do, that we use one main specially engineered vehicle to do that, and it's in the insurance world.
Yep.
But there's lots of types of insurance, Jonah.
That's right.
Remind everybody what types there are.
Of life insurance?
Yeah.
Or just all sorts of types?
No, they don't care about all that.
All right.
The main types of life
phone
insurance
and car insurance. Okay, life insurance. So the really two main types of life insurance are going to be term life insurance and whole life insurance.
Right. So you may have also heard these in terms of like permanent insurance and temporary. You don't really hear the word temporary, but sometimes you hear the word permanent. You hear universal as well. We're not even going there. But so we've got the two main types, term and whole.
Yeah, and really different situations call for different types of insurance. We like to equate term insurance and whole life insurance to actually renting versus buying. If you think of like property or houses, real estate, whatever you want to do. A lot of the term aspects of insurance are like very similar to renting something.
Right.
So you think of it like if you are renting in a house, renting an apartment, whatever, you're just renting, you have the ability, the use of that space for a limited amount of time.
As long as you have
whatever the contract
term,
is. Yeah,
right?
whatever the term is.
The lease.
Right? So, so with terms, they're very popular term of a life insurance would probably be like 10 years, 15 years, 20 years, 30 years. Yep. Those are normally the popular terms. And I believe 30 years is the longest one. I don't think I've ever seen term for longer than 30. I'm not sure if you can.
Madonna?
Yeah, I've only ever seen 30. If you've seen more than 30, say something in the comments,
please,
and I'll go digging. But I've never seen more than 30. Also, with term insurance, or with renting, there's no equity built into the house, into the apartment, right? You're not earning any sort of dollars, any sort of equity, nothing like that.
Yes,
and that's going to be the same with.
It's kind of like
term.
You're borrowing it from someone else. Someone else
for
owns
a little bit
it,
of time, right?
Right. At least obviously, if we're talking about like renting your apartment or your house, it's not yours, so you don't have to worry about all of the risks. You don't have to worry about all of the pieces, because you just need a portion to use for a while.
Right. Exactly.
Yeah.
And then I was going to say one other thing, but I thought of something that's like important, staggering to me when I realized this was the actual number.
Okay.
So most people get term insurance. Here's how it works, generally speaking. Most people are going to get term insurance when they're younger, in their 20s, in their 30s.
Right.
That's when they're going to get term. They're going to get long terms. 20 years, 30 years, as long as normally a lot of people who get term insurance go really as long as they can go.
Yeah.
So the thing about it, you got to think this through. If you're a 20-year-old or a 30-year-old and you're going to get 30-year term insurance, the price point on that term insurance is going to be relatively low.
Why?
The reason for that is because the insurance company, based on probability, based on the actuaries that the insurance company has, they can kind of tell with your health and other things that you provide them whether or not you're going to be alive during that term or whether you're going to pass during that term.
And the reason that they're taking a risk there is what?
Right.
It's the main reason
actually believing that you're not going to die during that term.
So we've got to make sure even higher level, of course, life insurance is going to cover a loss, right? We're putting risk transfer on someone else. So if I die, then someone else will pay for it. Right. That's what's going on. So the risk here is that the insurance company is going to take on my liabilities, help my family out, pay off my debts, whatever my beneficiary really wants to do with the money. But that's the idea on why I would get it.
Right. Exactly.
Yeah.
So here's the thing that makes it crazy. So when you go, so let's say you're 20 years old, you buy a 30-year term policy. So that means at 50 years old, it done.
Would be defunct. It's over. The term has come and gone. And
so
lapsed.
Again, at 51, if you still need life insurance, meaning I want to provide money for my significant other, for my family, for my friends, whoever's going to incur the funeral cost, the final expense cost, if I still need money for that, if you try to go get another term policy at 50 years old for 30 years, 20 years, well, the price point on these policies is astronomical. It goes through the roof because the insurance company knows they'd get you another 30-year term policy. This time, you're going to die. You're
the likelihood that you die is so much
way higher, right?
And so that actually brings up two things that some people don't think about. And it's okay, because if you are younger and in good health, the only reason you may die during that term is because of an accident. It
right.
wasn't expected. And that's why that price point of you renting the ability to have your risk covered by someone else is relatively low. So when we're talking about this, ladies and gents, we're talking about numbers that some of you know, but just to give you a reference, if you are, Jonah, let me pose this to you. Hey, man, I'm 25 years old. I want a 30-year term.
Okay.
And I think that my death benefit should be about $250,000.
Cool.
How much do you think that would cost in premium?
Oh, not very much. $25.
Probably at the most.
$50.
Yeah, probably at the most.
Yeah.
Per month.
Yeah.
Per month.
Yeah.
Okay.
Much.
So now let's go to that term has run out. 25, 30 years later, I'm 55.
Right.
So if you're 55 out there, think about what your liabilities are at this point. Think about the risk that is being transferred, that you need to transfer to someone else. So think about your liabilities in terms of your home, your cars, your boat, your other debts, your family, what age your kids are.
Right.
But 30 years from this point, I'll be 85.
Yep.
So I want $250,000.
But you probably need more now that you're older.
Right, because you have more liabilities, right?
Yep.
You have more things to cover. The house mortgage is probably $250 by itself.
Most people realize that the older you get, the less death benefit they like to give you.
Yes.
Because you're older, they know you're going to pass this time.
Yep.
Right?
Yep.
Okay.
And that cost... so obviously there's a lot of things going in here, but let's assume that, hey, I didn't do as well with everything else I've got out there in the world, whatever that may mean, investments or whatever. So I want to be covered still at 55.
Yep.
I want 30 more years.
Okay.
I got 30 before. I'm 55. I do have bigger liabilities now, but let's just go for the same death benefit number, 250. Someone else will pay it. How much is it going to cost me for someone to insure?
A lot more. And here's the crazy part. I actually ran across a couple yesterday who were in this situation.
Okay.
They were about 50. I think she was 55. He was 56. They had a lot more death benefit, granted.
Okay.
They had about $750,000. But you will not guess that this premium was crazy.
So their term had run out.
Their terms run out.
So they had 30-year, 20-year terms that had run out.
I think they had 20-year terms specifically, and they wanted to do another 20 years at 55. Their premium went from, so again, we gave you the kind of example, like $25, if that, right? When you start.
Which is, if we're trying to take care of our families, everybody goes, oh, I'll do that. No problem.
That's Netflix, 2 accounts.
True.
Netflix price is going up, I think. I'm not sure.
Disney plus Netflix.
Yeah, that's it. Okay. The premium on the renewal when they were 55, wanting to do another 20 years or 30 years, it was $3,000 a month.
$3,000.
It's like impossible.
You had to
break
the
news
to
going to go
them?
this time. I didn't break it to them.
Okay.
They already knew that, but that's why they were looking for some other options, because how can you afford that? That's crazy.
Sure. I mean, each person,
three house payments. Each person.
Okay, so we're talking $30,000 a person plus 2 people, $60,000 a year.
Life insurance.
To have life insurance, right? Okay, so ladies and gentlemen, there are reasons to have term insurance. Have you ever bought term, or do you have any?
So actually, I had some group sponsored term insurance, but I've never actually paid for term insurance out of pocket.
Okay, got it. So that's another way that term is often offered to people in the Western world here in your job. So you have a job, they offer term insurance just like they'd offer other benefits for being an employee. Yep. And of course, the term there, ladies and gentlemen, is probably more pronounced not as like a 20-year or 30-year term. It's going to be the term you live. I mean, you work at that job.
The term of your job.
Right. So if you leave,
get rid of it.
Remember, you don't have it anymore. You did not own that if it's group insurance, right? Okay.
So realistically, I see a lot of people try to lump that in. Like, oh, no, my death benefit's good because I got $50,000 from work, and then I bought $50,000, and I'm going, I mean, are you working there for the rest of your life? What is? That's only if you pass while you're working there.
Right.
And if that happens, that's terrible. I mean, no one wants that to happen. You know what I mean?
Right.
So, yeah, I like see a lot of people lump that in. I don't like to lump that one in.
Sure. Yeah. My job, I had term insurance. I bought it off a college buddy, right? Working for one of the two big companies that kind of have a lot of reps in our neighborhood.
Sure.
And called me up, explained to me the risk that I could put on a future family because I was single at the time. Talked about making sure that I was covered now in the event that I was not healthy later on, right? And I was like, oh, yeah, totally understand this. Thankful to the guy for helping me understand that. And he explains to me term, and I said, I'm going for that. So I get term insurance for 20 or 30 years. I think it was $300,000. And you're right, it cost me like $17 a month.
Yep.
Was no big deal. But that's not the only thing that he talked about. He also talked about the other type of insurance, which I had no understanding of at that time. And that was whole life insurance. Did not understand it, did not understand how it works. And he said, man, I suggest this because you get to be locked in. You'll own this. So help us understand some of the differences between the two.
Sure.
We've talked a lot about things we don't normally bring up when we're helping people in banking. And it's cost of insurance. It's, of course, term that it would exist.
Sure.
And the death benefit and how important that is should you decide to die one day, which pretty sure we all
we've really been
that.
talking about death benefit. So let's start there with whole life insurance. So again, we got to kind of compare and contrast to get the best picture. So 20-year-old, 25-year-old wants to do term insurance at $250,000. We put that somewhere under $25 a month. That same 25-year-old wanting to do whole life insurance. So understand, not a term. It's your entire life. They're going to pay out a death benefit anytime.
Pun intended.
Because
whole life.
Yeah, you have to pass.
You have to die.
So the second they sign that contract, they know they're paying, right? So therefore, they're going to charge you a little more. Does that make sense?
Right.
Right. Now, we didn't even say this. We were supposed to say this. The percentage of term policies that actually pay out.
Right? Very low.
Right. Very low. So I want to go back for just a second. The percentage of term policies that actually give out that death benefit is somewhere around 3%. Because the other 97%, the insurance company's not stupid. They know if you pass during that term, it's going to be an accident. And if you
untimely.
Yeah, and
you
if
get
you're
sick,
and then again, like we said, that's why they charge so much when you try to get another term when you're of age that something could actually happen to you. Because they want you to pay for, I mean, they have to send, again, if you give them $25, they got to give you $250,000. Who took the risk?
They did.
Right? So then when they actually know you're going to go, they're going to charge you appropriately to give out $250,000.
Right. Makes sense.
I mean, it makes sense.
Yep.
So anyway, back to whole life insurance. Whole life is like owning. It's basically like owning. So it's yours, right? It's yours when you own it. They can't really take it away from you. It's yours. You also build equity. So this is an aspect of whole life that term just doesn't have at all, which is cash value.
Which is just like owning a home. So most people understand that.
That's why we relate it like that.
Equity value. So you're going to be able to own more and more of the situation because at the beginning you're actually you only have, it's paid up. You only have part of it taken care of. So think of it like this. You've got your down payment on the house, right? But you've borrowed the rest of the money needed. So you don't actually own, this is actually a big pet peeve of mine. You don't actually own the house. The bank owns the house. The finance company owns the house when you only put down 10, 20% because you've borrowed the rest. So your equity value is only up to a certain amount. Works the same way in insurance, whole life. So it's normally just easier to explain it to people that way.
But having these option of equity value, option of cash value is only available in whole life policies.
Yes.
Right. Now, whole life has in the past, you can think about some very prominent people back in the 70s, 80s. You can think about maybe your favorite internet star right now telling you how to do things in finance. Whole life does get some bad reps, but they're talking about the death benefit aspect only, really. Right. A very popular person will literally tell you, don't ever get whole life. It's too expensive. You should buy term insurance and invest the difference. Well, if you're talking about too expensive, you're talking about the death benefit aspect.
You're talking
That's
about
what you're talking about.
Right. And you should never use, the other thing you're going to hear a lot is you should never use there shouldn't be any reason that you should use cash value as this savings holding account as an investment.
Right.
Which is not, of course, how we teach folks. So, we would agree with that. Actually.
Right. We would agree. We would agree with that. There's nothing wrong with that. But what we are doing with banking is just different from what they're saying, what they're preaching, what they're telling the masses, right?
Right. Banking is not the same thing as investing. It's not the same thing as having a death benefit. Has nothing to do with that. But of course, whole life is going to pay out. So there's going to be a coverage of the risk and the loss. So life insurance, no matter which way you swing it, at least at the outset, has a death benefit. So remember that, everybody. I think sometimes when we get people going down the route of banking so often, and we strategically do that, we don't want to over talk about other types of insurance that we're not dealing with. We don't want to over talk about a payout at the end, a death benefit, a beneficiary, because that doesn't have anything to do with banking. But I think sometimes people get lost and they forget that it's life insurance.
Yeah, that happens. But I like when that happens. That makes it a little easier. I don't like the opposite, where I'm trying to teach them about banking and what to do and how to do it and how to grow your cash value, and all of their questions are centered around death benefit or insurance.
Yeah.
And it's like, you're not realizing that this is just the vehicle that we have. So there are some perks of the vehicle, and there are some things that come attached to that vehicle, like a death benefit. But that's just the vehicle we're using. This other thing, banking, which is what we're teaching, is really the most important part. That's what we need to focus on,
right?
Learn how to do, right? So I'd honestly rather have it like that, where people forget that it's insurance. That actually makes it a little easier. I always find it funny when people do forget and they go, Jonah, how do I get the money out of my policy? Or how do I do this and this and this? And I'm going, it is insurance. They've got a website you can log into and, look at it.
A lot of people we deal with don't even understand that. I mean, you can call them.
Right.
And just like you have Netflix, you can call them. You can call the phone company and just say, hey, how much money can I get? They'll tell you, and they'll send it to you. Right. You own it. You're in charge.
So that makes it a little easier. I like that. But, there are just some big, big differences between, and that's really the main one, the equity value, the cash value between whole life insurance and term insurance. And again, there's a different scenario. There's a different need for the different types.
Yeah. Right? So some of the reasons that you would want to have term insurance, because we don't hate it and we've owned it in the past, is if your banking system, let's say you want to get started, you want to do what we're talking about, you want us to help you do that, we're happy to. But in addition to your banking system, there's a lot of times, if you're our age especially, but lots of people across the age spectrum don't actually have enough deposits, what we call premium money, to actually merit what they would need if they actually died.
That's true.
So in that scenario, there's actually riders we can add on, as well as maybe if you had a term policy and you bought it back in the day, keep it. It's totally fine.
Yeah, there's just a need for the death benefit, and some people don't realize that. So I implore you, realize that, understand that if something were to happen to me today, right?
Yeah.
My family has stuff to pay for, and they have income to replace.
Correct.
They need my death benefit. I need to have a death benefit. So if I want to get started with banking, and I'm banking, again, that banking policy is going to have a death benefit attached to it. But if that's not enough for my family, and I need a little bit more at a relatively low cost, well, I'm going to recommend term insurance to you.
Yeah,
absolutely.
Go grab a term.
If you're looking to get death benefit, that's what I'm going to recommend, right? Mm-hmm. If you're looking to build cash value, if you're looking to accumulate, right, I'll recommend banking. But if we're talking about death benefit, I'm going to recommend term.
Yeah.
Absolutely.
And like I said, there's many people who come through our office and they see what we do. They understand it for the first time. They get excited about it. And so they want to start a banking policy, and they already have some other insurance, life insurance, like term. And I generally say, especially at the outset, at the beginning, just keep it. That's fine.
Yep.
One of these days down the road, it's likely you're not going to need that death benefit the way you need it now. But let's not worry about that. Keep it.
I think R. Nelson Nash says in his book, Becoming Your Own Banker, that if you realize that with banking, you can satisfy your need for financing, you'll actually have more death benefit than you can imagine that you need.
Yeah.
And I honestly feel like maybe I'm in a place like that. The death benefit after a few policies has gotten so big that it's like I would have never gone out and purchased that much term insurance.
Right.
I would have never done that.
Remember, in a term life insurance contract, your death benefit will not go up.
Right.
It will stay level. In the way we engineer whole life banking policies and the way they're engineered, the death benefit keeps climbing.
Right.
So you are going to be able to one day, when you are out of debt, when you have financed your own lifestyle, paid yourself back, and grown your cash while you're living, your death benefit got so big, it has covered any need that you'll have for dying.
Yep.
So you're able to take care of yourself and your life and your family while you're living, and your death benefit grew to in most cases over the course of time. Your death benefit is way bigger than you ever needed.
Yep.
Your family's just going to get a whole bunch more money, church, charity, however you want to do it.
Yep.
Yeah. So you've got to understand here what we're helping you see is some of the differences, just to make sure, for those of you who might be very elementary on how does insurance work, which one is right, why are you using one over the other for this banking idea. But you're probably also realizing that, wow, if I go along with what you guys are saying and I help you understand banking, it solves way more problems than you're even thinking it does now.
It does.
So anyway, ladies and gentlemen, that is our show today. Drop a line in the comments, subscribe to our podcast. We'll see you on Facebook, and we'll keep cracking the code to cash flow.